Good morning, everyone. Welcome to Capstone Coffee Conversation. Today is Tuesday, August 13th. I'm your host for the day, Brian Felshaw, up here in Silverdale, Washington. And today I'm joined by a very special guest, Kunal Kishore of JP Morgan. Kunal, good to have you.
Thank you. Good to be here.
Yeah, looking forward to it. Kunal and I talk pretty often. He's a great resource for myself as well as all the other advisors at Capstone in helping access some of the big institutional knowledge behind JP Morgan and all the access they have to industry data. We're going to get into some slides today, talking a little bit about some general principles of investing, a little bit about market volatility, which I think is very timely. With the last couple of weeks, there's been a little bit of volatility. Talking a little bit about the role of emotional bias in investing, talking about the role of your asset allocation long term, and a little bit about cash and that role that it plays right now in the market, and what we might see things play out with rates. As usual, please put your questions in the chat down below. There should be a little button for placing a chat to Moesha, and we'll revisit those at the end. So, Kunal, before we dive in, why don't you tell us a little bit about yourself and your role with advisors with JP Morgan?
Sure, absolutely. First, Brian, Ryan, and team, thank you for inviting me to this Capstone Coffee Conversation. It's exciting to be on here and meet with some of your clients and give me some time to just share some of our views here. I've been in the business, in the financial service business for close to 20 years. This is my second stint back at JP Morgan. I was on your side working with high net worth clients, and then I worked at Goldman for about 7 or 8 years in a similar role. And my role essentially for the last decade has been talking to advisors and helping them make sense of what's happening in the markets, and then also talking to their clients. Obviously, there's a lot of volatility in the markets, and how do you make sense of that? How do you talk to clients about diversifying portfolios? How do you implement portfolios? And sharing sort of JP Morgan's views, if you will. So that's where I kind of sit into the picture. So yeah, hopefully that's helpful.
Perfect. Thank you. Well, let's get into it.
Yeah. Well, look, obviously lots to talk about. There's been some volatility. Have you heard about the markets having some volatility recently?
I think I have. I think I have. Yeah.
Well, look, the last 7 to 10 days, we've had a lot going on, even within the firm, just trying to figure out and get perspective on what's happening. Obviously, there's news about geopolitical conflicts. We have elections coming up. There's a potential slowdown in the economy. But all of this is normal. And if I may, I'm going to share a slide here to start out. And bear with me a second. It should pop up here. There we are. Is everyone able to see this okay?
Yep, perfect.
So I think what I wanted to do today with our conversation is really give perspective on how to think through some of this volatility. And the first thing I wanted to share is this particular chart. It's from a piece that we have called the Guide to the Market. And we use this chart with our clients, with advisors, internally within our asset management business. And I think it tells a really nice story. And what it's saying is that volatility is normal. And one should not let this volatility derail their investment plan. And let me help put this picture to light here. This chart is going back to 1980 till today. That's 44 years of investment returns. And what this is showing, if you look at the gray bars, the gray bar is the return of the stock market, which is the S&P, for that given year. So for example, in 1980, the S&P gave you 26% at the end of the year. In 2022, it gave you, 2023, it gave you 24%. Year to date is up 10%. The red number is reflecting in any given year the worst drawdown intra-year, meaning in 1980, even though it ended up 26% for the year, it was actually at one point down 17%.
Right.
Similarly, in 2023, we ended up with a fantastic year. The S&P was up 24, but the market at some point was down more than 10%. So put in other words, despite having an average drawdown of about 14% intra-year, about 75 to 80% of the time, 33 out of the 44 years we're seeing here, the S&P has actually ended up positive. Put in other words, 94% of the time on this chart for the last 44 years, the S&P has gone down more than 5%, 94% of the time in any given point in a year. 75% of the time, it's gone down more than 10%. And this year, we haven't even had a 10% correction. So the S&P is actually still up 13% for the year. A 60-40 portfolio is up about 8% for the year. So I love this chart because it just gives some perspective on all the volatility that's happening and maybe kind of helping cut through some of the noise that we maybe hear, to just give some perspective on what's happening in terms of volatility in the markets. I'll pause there, Brian, and see if there's anything you wanted to touch on.
Yeah, I'll add a few things. I love this slide. I try to revisit this slide with as many clients as possible. And what's interesting, like you said, is every single year at some point we go into the red. I mean, you can almost draw a line right through that average. I think you said 5% or so. And this year, I mean, it looks like at the beginning of the year we were down 2% at one point, but even after the last 2 weeks, a little bit of a sell-off in tech stocks, about 10% or so off the top of my head. The market's still up 10% for the year. It hasn't really gone negative. So despite, as you said, the noise, the world, the news, making it seem like the sky is falling, this is actually pretty small and normal, as you said, in the big scheme of things going back. I also love your example of 1980 because there was a lot of volatility in 1980. I think there's some parallels to, the late 70s, 1980 to today with inflation and rates and kind of thing. And how many people do you think panicked down there when it was down, 17 and didn't experience the get back to zero and then the plus return at the end there? So, it really is true. Their volatility is normal. Absolutely is normal.
Exactly. I mean, you nailed all of those points, and it is normal, and I think it's a part of an efficient market. And I think when you don't necessarily see some volatility, it feels kind of good. But then part of the market being efficient, it's nice to have some of this volatility, which lets out some of the air, if you will.
That's right. That's right.
Well, maybe another point I'll just quickly share is, our sort of base case is obviously we're seeing a bit of a slowdown in the economy. The labor markets are still slowing down, but overall, it's still a fairly decent economy. I think consumers are still wealthier than they were, from 5 or 6 years ago. And we're seeing some of that. If you look, obviously being a big firm, we're able to see sort of flows in sort of savings and bank accounts, and obviously all anonymous, but it just gives us kind of trends of balances. And it's nice to see that folks are still, have some excess cash. They feel like they're in a decent place, and they're still spending, which is driving a lot of the economy. So even though we're seeing a slowdown, albeit, the economy is overall pretty okay. And this volatility is pretty normal.
Yeah.
Yeah, sorry, go ahead. I don't know if there was anything else you wanted to touch on.
No, I think that's a good segue to talking about consumer sentiment. That's right.
That's right. I love this chart. This is called the consumer sentiment chart. And again, this is part of our Guide to the Market flagship publication. And what this is, there's a survey that has been done by the University of Michigan from the early 70s. And they call it the Consumer Sentiment Index Survey. And essentially what they do is they go out and they poll about 600 to 800 people, giving kind of a representative sample of the broader country to feel and get sentiment of how people feel about the economy. So do they feel really good about the economy? Is everything sort of rainbows and sunshine? Or do they feel like it's a bit of a doom and gloom scenario? They don't really feel very good about the economy. And so that's a survey that's been done since the early 70s, and they put this into an index called the Consumer Sentiment Index. And if you notice on this page, there's 9 distinct peaks and 9 distinct troughs in sentiment. What that means is if you look at the blue dots on here, each of those dots are peaks on top, and each of the dots at the bottom are troughs, meaning people are feeling sort of the worst about the economy going back to early 1970. The biggest takeaway here is if you had invested in peaks of sentiment, meaning you feel like everything is going really well, I really want to invest into the markets, everybody seems to be investing and they feel really good about the economy, the forward 12-month return on average on the S&P was about 3.5%. Subsequently, if you actually invested in the troughs, that means when people don't feel very good about the economy, things are slowing down, they feel like, this is not really a good time, the forward 12-month return was actually 24.1%. So I think the takeaway from this particular chart is that the dawn is almost always before the darkest. And I think one should, when one feels like maybe they shouldn't be investing in the markets, they may want to consider and see that they're, historically, you shouldn't make emotional biases when it comes to how you feel about the economy necessarily. And you should always stick to an investment plan that you've worked with your advisor. Brian, I'll
Right.
pause there and turn it over to you and see what any thoughts from your end.
Yeah, it's always, everybody always goes back and says, oh, I wish I invested in Amazon back in 2000 whatever, but when those times actually come, when there's uncertainty, everybody's scared to do it. Right. So what I think is interesting, Kunal, if we look at the right side, the more recent last couple of years, we had a really, really big dip down in consumer sentiment. I think that was, June of 2022.
That's right.
Inflation was 9%.
Yep.
We were really, really stressing. The market was going down, rates were going up. And it's definitely climbed up quite a bit since then, but it's still not quite to that average where, multiple year average. And I think the technical term is meh. The consumer's feeling kind of meh.
Exactly.
about where we are. So we definitely improved, but at least just based off this, it would suggest that there is still some room for growth before we get to those peak exuberance times that we've seen. So really interesting insight there.
Great observation. As a matter of fact, June of 22 was the worst sentiment we have felt going back to the history of this.
Yeah.
Which, if people in June of 22 felt, sort of followed this index and felt that, this is the worst we've seen since 1970, if you will, in terms of sentiment, and hadn't invested, you wouldn't have had a lot of that upside we'd seen in the markets in 23 and so far this year.
Right. Yeah. Really interesting.
Well, great. Let me turn to another one of my favorite slides here within the guide, and we'll turn tables a little bit. Brian, you had mentioned diversification earlier, and I'm sure that's a term that, a lot of folks have heard, and kind of what does it mean and how do you put it into perspective? And I don't know if folks have seen on this call, have seen this chart before, but I call it the quilt chart. I don't know if you could, yep, there we go. I call it the quilt chart. I also call it the Skittles chart. So whatever you prefer, you can call it. But this is actually called, in the technical term, is the asset class return chart. And the picture that this is trying to tell you, or the story, is this is going back from 2009 till today, and it's giving you 15 years worth of returns across all the major asset classes. So large cap stocks, small cap stocks, commodities, fixed income, which is your bonds, and even cash. And so this is sort of painting a picture of actual returns at the end of each of those years. And what you'll find here is a pattern. And the pattern is, there's just, to your point earlier, Brian, there's just no way to ever tell how one asset class is going to perform better than the other in any given time. If you look, there are times when commodities are at the bottom, there are times when commodities are at the top. Small cap is at the bottom, small cap is at the top. Emerging markets and international is at the bottom, it's sometimes at the top. But one constant you'll find here is this gray box called the asset allocation box. And this is a traditional diversified portfolio, like a 60-40 portfolio where you've got some stocks, some bonds, some international, a little bit of emerging markets and such. And if you'll notice, the asset allocation box is never at the top, but it's never at the bottom either. And it gives you kind of a neat, kind of great way to just kind of go through the market without a significant amount of volatility. And if you look here over the last 15 years, the asset allocation box is right smack in the middle, giving you about an 8.1% return over the last 15 years with pretty meaningful volatility. I'm sorry, but with not a lot of volatility, much less volatility, sorry. But cash, on the other hand, if you'd left it your money in cash, your returns would have been 0.8% at that same time frame. And so not that we're saying that you shouldn't have money in cash, and it's a great place to obviously be, especially now, given where interest rates are. There's some really nice, finally, we're starting to get some yields. But, sitting on the sidelines sometimes and not investing into the markets can have repercussions. And this is just giving you a nice idea of what asset allocation has done over the last 15 years through many market cycles. We've had obviously elections, we've had all kinds of geopolitical events happen through to the last 15 years, but you've still had a nice 8.1% return. So that's what this chart's trying to share with you.
Yeah, I think this is really interesting. I'll use a baseball analogy since we've got Major League Baseball playoffs right around the corner. The team that actually ends up winning the World Series more often, they're not the team that hits the most home runs. They're the team that gets the most singles and doubles and just keeps getting people on base over and over again, not the ones that swing for the fences. The ones that hit all the home runs, they get the ESPN highlights and whatnot, but they don't actually end up winning the World Series. And I liken that to your asset allocation, right? Your 60% stocks, 40% bonds, 70% stock, whatever it may be for your personal situation. Kind of just consistently trying to get on base. When you try to swing for the home runs, you might hit a couple, but you strike out a lot more. And it's harder to be consistent when that's what you're trying to accomplish, especially for, I would say, a lot of our retirees. You said something earlier, Kunal, I want to come back to about how there's no way to know for sure what's going to be at the very top the next year. And I totally agree with that. I think that's the point of diversifying, is being able to have a little bit of all of it and be consistent. I will say the one thing that we hammer home with clients a lot that I think also helps augment this.
Yeah.
Weighting to areas of the market that are undervalued, looking at values. What's at a high PE ratio compared to its history, right? Where is the market maybe getting a little frothy, and where is it a little bit underappreciated? And I think that helps augment this asset allocation over time.
100%. I think that's right, and that's where obviously you and your team come in and are great resources there.
Yeah, I think this is great. It's interesting you point out the cash, because I think cash is kind of our final point here.
Yes.
You want to go to the next slide?
Yes. This is another pretty neat slide, and it took me a little while to kind of read through this and get a feel for it, but essentially what this slide is telling you is that cash isn't always king. And I know it's been sort of frustrating for a lot of clients to not be able to get a lot of yield from your savings accounts and CDs and money market accounts, and we're finally getting some of that yield, and it's great to see that. But I think one should likely consider some opportunities outside of cash, given in the environment we're in. Not that you shouldn't be in cash for parts of your portfolio, and obviously you talk to advisors on that particular side. But I think
one thing, when we say cash, we are talking about CDs, short-term CDs, money market accounts, that kind of thing.
Exactly. Right. And this particular example here is a 6-month CD. This is an example of the 6-month CD. And what this is essentially telling you is this is going back to the last few rate hiking cycles, meaning when interest rates hiked up. If from of June of 22 till today, interest rates up over 500 basis points. So we've had a pretty massive, what they call a hike in rates, and it's a cycle of hike in rates. The last time, a few other moments in time where this happened was in 1984, 1989, 1994, 2000, 06, and 2018. And what each of these years are telling you is every time you had the end of a rate hiking cycle, meaning the Fed has finished raising rates, almost always it's better off being outside of cash. Not that you shouldn't be part of your portfolio in cash, and cash is still pretty attractive. The returns are generally better outside of cash, and things like the S&P, the core fixed income in terms of ag, or even in a 60-40 portfolio. I'll give you an example here. We'll share a few. 1984, if you look at the gray diamond, that was what the peak of the 6-month CD was after a rate hiking cycle, which give or take here about 12%. That's what 6-month CDs were giving after rates were moved up in 1984, and it was giving you about a 12% yield, which I think is a pretty good yield if you ask me. However, the forward 12-month return in cash post that peak was about 10%. The forward 12-month return in the S&P was 31, in core bonds was 30, and a 60-40 portfolio was 30.
Wow.
Similarly, in 1994, the peak of yields of the 6-month CD was about, I'm going to say about 7% here, which is sort of, obviously it's a little higher than we are today, but the forward 12-month return of the CD was about 6. The forward 12-month return of fixed income or bonds was about 18. The S&P 500 about 38%, and a 60-40 portfolio about 30%. And by bonds here, I mean just the Bloomberg aggregate, US aggregate bond market.
Right.
Now, obviously, it's not indicative of what potentially could happen, but it just gives you a guide as to, when you have these rate hiking cycles, the 6-month CD has hit the peak of the post the rate hiking cycles. There are some opportunities outside of cash you may want to consider, albeit, after discussing with the advisor, the best option there for you.
Yeah, I think this is a great insight, Kunal, because I would say at this point, I probably at least once a month have a conversation with a client saying, hey, I've got a CD maturing, up here in a couple of weeks. I've got to do something with it. Should I re-up it or should I do something else with it? And obviously, it always depends on the goal. Some people are saving for a house and need to be really conservative. Some people are long-term retirement or just have excess cash that they want to invest. And so it all depends on the situation. But I think this is a great insight that, you have to be looking ahead at these patterns, because if the Fed starts to cut rates, that makes some shifts in the market. And historically, this is how it's played out. And so that's a really, really good insight to understand, considering, I think when you and I talked earlier, there is about $6 trillion in money market accounts right now.
Yeah.
Across the country. That's a huge amount. And that's not even counting savings or CDs, right? On top of that. So there's a lot of money, if you will, kind of sitting in these types of investments that this pattern could play out, because that money's got to go somewhere, either reinvested into those CDs, or if people decide to do something else, that money's going to find its way into other assets potentially.
That's right. And as rates, there is a significant amount of money sitting in sort of the sidelines, if you will, and things like money market accounts, like you mentioned, Brian. I think that is the number, 6 trillion or so. But generally, when rates move down, and our view is that obviously with the slowdown in the economy, the Fed is likely going to move rates down here, starting potentially in September, and that generally bodes well for bonds, where you get a little bit of price appreciation. So there's likely, if you're in the money market fund or CD, the rates generally go down on the short end when the Fed moves rates down. and you don't participate in some of that upside with the differential, if you will. So hopefully that was
That's right. Some of our clients on here might remember we've talked about that before with
yeah,
unfortunately back in 2022 on the other end when rates were climbing and bond values can get hurt by that.
that's
But
right.
we're staring down the pike of potentially the other side of that, where if rates start
That's
to come
exactly right.
down, the longer term can benefit. So
And
yeah,
that's part of what this particular chart is showing you is that if rates, essentially in each of these cycles, post the peak of rates, rates started to move down, and that's why you had better returns, in things like stocks and bonds in a 60-40 portfolio versus cash.
right.
Yeah.
Right. I think those are the big four slides we wanted to cover, Kunal. I appreciate it. Let's go ahead
Yeah.
and see if we have any questions from the chat. Moesha?
Got one for you. Should we be making changes to our investments when the market dips?
I'll take that one, Kunal. So I think that there's kind of two ways to look at this. If you are in a situation like we just talked about, where you've got money in a CD that's maturing or something like that, and the market dips, that could be an opportunity to, I mean, we use the term buying opportunity all the time, right? And it could be an opportunity to readjust your strategy and potentially take advantage of that. On the flip side, I would say making changes out of fear is generally not going to be a great thing to do, a great long-term strategy. Like we talked about in the first slide, volatility is normal. It's a part of the journey. And, working with us, we try to weight you to where you're going to have the most value anyways. So if you're fully invested and you want to make a change just because we're scared, that would be something I'd revisit with your advisor and kind of talk about, does this make sense in the context of your long-term plan? I had a family member just yesterday reach out to me and say, I keep hearing about these gold manager IRAs, and I think I should move my entire IRA to a gold manager. And I just talked about, I would reconsider making big shifts like that out of fear. We want to understand just what volatility is and that it's part of the journey, and make sure we're making those small adjustments that help us be consistent, like the asset allocation chart. So different ways to look at it depending on your goal. But generally, I would say if you have an opportunity, great. But if you're making changes out of fear, probably not. So any other questions we have, Moesha?
Nope.
Okay. Well, thank you, Kunal. Really great, valuable information. I appreciate your time. Hopefully the clients took away something great. And as always, if there's any other questions, feel free to reach out to your advisor and we can talk more.
Awesome. Well, thank you for inviting me, and hope everybody has a great week.
Yeah. Thank you, Kunal. Thank you, everyone. We'll see you next time.